Hi, everyone, and welcome to our webinar. Thank you all so much for joining us today. We'll be waiting 30 to 60 seconds more to allow more people to join in, and we're really excited to bring you today's presentation. As always, if you have any questions at all, you can type them up in the live chat box on your right-hand side of the screen. We'll be able to answer your questions right after the presentation. Brad, before we begin, anything that you'd like to add?
Not exactly, other than welcome everybody, and just while we wait a few more minutes here for people to come in, just if you could type into the chat that you can hear us okay, that would be appreciated. Also, just if you have any questions, make sure that you put them into the chat before you forget what the questions are, because we will give time to get those questions answered for sure. I hear you guys. All right. Thank you, V2007 incognito over there. Appreciate it. All right. Yeah. Give this a couple more
All right.
minutes.
Mm-hmm. All right, looks like we're already having some questions rolling in, and we'll be looking forward to answering those.
Great. Yeah. Sid, thank you very much. I'm trying to see, am I definitely live on Facebook? Like, I don't know if I'd be able to tell on my own Facebook page. Oh, yeah. It
Mm-hmm.
says live. Okay.
Yes.
Interesting. There it is. Cool.
All right. Looks like I can go ahead and start this up. Thank you so much for waiting, everyone. Welcome, everyone, to Solo 401k, the last window to lock in your Solo 401k tax benefits for 2025. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I briefly want to introduce our speaker for today, Brad Sininsky. He is a solo 401k and SDIRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brad is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you so much again for joining us today, Brad, and I'll let you take it from here.
All right. Yes. Thank you, Leah. Appreciate you helping out with this and introducing me. Thank you, everybody, for joining today. Sid, I will answer your question. It's not the exact topic of today, but I'll definitely address it for sure. Today, we are going to talk about the solo 401k primarily and how it works and why you might need to act quickly before the year is over. And yes, this is me. You already heard Leah introduce me. My contact info is there on the screen. This webinar does not provide is not to provide legal advice or financial investment accounting or other advice. If you need such investment or those types of areas to be addressed, then please seek out the proper professional. This is educational only. Why us? Well, we've been around since 2010. We have clients in all 50 states from all different walks of life. And we do have 5-star reviews on many of the major websites. And also, most of our clients come by referral, and most of our referrals come from our existing clients. And so I think because of that, it's a testament as to how, how our clients view us and our service that we provide is good enough for them to send their friends and family our way. So that aside, our mission is to help clients obtain control and protect their retirement accounts, and good planning and hard work lead to prosperity, Proverbs 21:5 says. And you work hard for your money. We want to come alongside you and work hard as well in this capacity of providing a truly self-directed retirement account, which is what we're here to talk about. So there's a difference between the conventional side of investing and the self-directed side. With the conventional side, yeah, I'm being kind of funny here with the horse and buggy versus the flying truck, but the conventional side is your stocks, bonds, mutual funds, ETFs, where most of Americans' retirement money is actually held, right? And nothing wrong with that. It's, in our opinion, just not the best way to do it. You can be truly diversified by doing that plus. And so that's what I want to talk about today is being able to, yes, invest in Wall Street, public assets, but also being able to invest in non-public assets, self-directing your retirement, not which mutual fund do I invest in, but what asset do I invest in? Mutual fund, real estate, crypto, precious metals, private lending, um, commercial real estate, residential real estate, tax deeds, mortgages, uh, private businesses. The sky is almost the limit, right? There are some things to be aware of about who can be involved in a transaction, and I'll cover that here in a moment. But the world is pretty much your oyster when it comes to self-directing using a checkbook IRA and a solo 401k. Ecclesiastes 11:2 says, "Divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth." And the idea behind that is, yeah, you don't know, right? So diversification is important, not just asset classes, but actual assets, right? So this provides a self-directed plan provides true diversification. A quick example of one of our clients here, and then I'll get into it. Avery from Boise is one of our solo 401k clients. And he actually, his goal was control of his retirement, right? I mean, that's what we do. We provide people to have control over where they direct their retirement funds. And he actually is the founder of a hard money lending company, J&R Capital, where he finds borrowers and then loans them money. So he originates the loans, services them, collects the payments, goes through the foreclosure process if necessary. Though I don't think that happens too often, maybe never so far, because he does a really good job of vetting the borrowers and the deals they want to borrow against before doing the loan. But that's his personal business. What he wanted to do is have a solo 401k adopted or sponsored by that business. I'll talk about why that's important here in a moment. And so he's doing hard money loans personally. He's got the knowledge, and that's the beauty of self-directing your retirement is you take what you know, understand, and can control, and you do that inside your retirement account. So he's doing the same thing using his solo 401k as the bank, as the lender, hard money lending, as he's doing with his personal business. So not only is it pretty safe because he's really good at this, but it has predictable results. And the best part about it is it's secured, but the loans are secured by real estate. So if there's a default situation, he can go foreclose on the property with his business, but also with the solo 401k. And worst case scenario, not that he's loaning to own, but worst case scenario, if somebody defaults and he has a $50,000 loan with them, or his 401k does, and he has to go through a foreclosure, maybe he has his 401k now has a $300,000 property, right? But only for loaning out 50,000, right? That's worst case scenario. So worst case is almost best case in a way if you think about it like this. Again, we don't want to go through the foreclosure process. We don't want anyone's credit to be screwed up from that, but that's the reality of when you have a loan secured by an asset like real estate, that's the potential outcome. So that's Avery. That's what he's done. He's been a client for about 18 months now, and he's doing great and loves it. So there's basically two self-directed options that we offer here at Sense Financial. You have the self-directed IRA, also known as the checkbook IRA, which we're not going to spend a lot of time on today. We're going to focus on the solo 401k, but I did want to mention it because we offer both, and not everybody qualifies for solo 401k. But just about anybody can have an IRA, right? To contribute to an IRA, you must have earned income. To have an IRA, you don't necessarily have to have earned income this year. You can inherit an IRA. or you can have had made contributions from the past and you just have an IRA that you're not currently contributing to. But you can unlock that IRA, whether it's Roth or traditional, and turn it into a truly self directed checkbook IRA with us here at Sense Financial to invest in alternative assets. Okay, so that's the self directed IRA side. On the solo 401k side, you need to have you need to be self-employed, and it's primarily for the business owner and their spouse. It actually works with partnerships as well. Any type of business can adopt a solo 401k plan. So you could have a single member LLC, a partnership. You could be filing as a sole proprietor, S Corp, C Corp. They all work, okay? As long as you don't have full time W 2 employees outside of the business owners and their spouses, then you can actually have a solo 401k plan. And by legitimate income, by the way, I don't mean passive rental income or Schedule E income or investment income. I mean actual earned income, real estate agent commission, hard money loans, returns from those. I mean, oftentimes short term rental income, property management income, mowing lawns on the weekends income, driving for Uber income, 1099. These are examples of earned self employment income. So, how does the setup work? Well, you have the sponsor. I just belabored that, so I'm not going to talk more about that. Once you determine you qualify, that first of all, talk to us. We'll talk through your situation, and then if it makes sense for you to have a solo 401k, you'll become a client of ours, and then the plan sponsor, excuse me, your business will adopt the plan. The trust and the adoption agreement is created. You are the trustee of the plan. So you have checkbook control, meaning you can direct all the assets of the plan. You can open up accounts, bank accounts, brokerage accounts, etc. You can sign on the dotted line as the plan owner slash plan trustee slash administrator of the plan. You actually have a few different titles, but ultimately you're the plan trustee. And the trust, the solo 401k is a trust. That's what holds all the assets of the plan. And with that power, as the trustee, you can open a bank account, as I mentioned. You open this bank account, that's the home for the funds until they're invested into an asset of your choice. And then all the income and expenses would go into and out of that checking account as you make investments and get returns from that investment. Okay. Contributions to the plan, we'll talk about that, can also start by going into that checking account and then being deployed into an investment. Okay. Whether that's going to a brokerage account like Vanguard or Fidelity to invest in Wall Street or into real estate, crypto, precious metals, private lending, whatever it is that you choose to do. You can use leverage. This is applicable to the IRA and the 401k. You just can't provide a personal guarantee. It must be non recourse. We have a great article on our website about this. And you can actually find a list of non recourse lenders at SenseFinancial.com /non recourse lenders. It's basically a DSCR loan, debt service coverage ratio loan, with a further point of it being non-recourse, meaning the property is the only security. Okay, your income, your credit, and your financial situation is not part of the underwriting to determine whether it's a viable loan or not. It's literally just the property and the performance of it and the reserves that are inside the IRA or the 401k. Usually you need about 6 months of reserves, okay? Principal, interest, taxes, insurance. And so you can check out that website for more information to see if you want to talk to any of those lenders about that. Which, by the way, let me go back to that, is a reason why investing in real estate using your 401k is such a powerful thing because you can increase your return monumentally by getting a mortgage, right? It's really hard to do that with margin or, by getting a loan for buying more S&P 500, okay? You could use margin, not necessarily in your retirement account, but you could do that with a personal brokerage account. but it's not the same as getting a, 50% of a 500,000, $1 million house actually financed, right? And the numbers are solid. Like the property's going to cash flow or the loan's not going to go through. So you're making a bad investment is going to be a lot harder when you get a non-recourse lender involved. All right. But you could also do it with cash. It's totally okay. The reason the 401k is so powerful, another reason, is because the contribution limits are so high. Over $77,000 per year per participant if you're over 50. 70,000 for 2025 if you're under 50. And the reason is because you're both the employer and the employee. Therefore, the IRS allows you to contribute as each. The employee can make their own elective deferral payroll contributions, and the employer can make a profit sharing contribution. So the employee max is actually the same as a W 2 401k plan you have. In fact, you can't double dip on that. So if you're maxing out a 401k W 2 employee contribution, you can't have a solo 401k on the side and make double up on those employee contributions. You can do the difference, 10,000 here, 13,500 over here. That's totally fine. So having another W2 job doesn't preclude you from having a solo 401k as long as you're also self-employed. It just might affect the way and the dollar amounts of the contributions that you're going to make. The employee elective deferral is up to 100% of your self employment earnings. It's not a match, it's not a percentage, it's just dollars going in. And the contributions can be either pre tax or Roth. Additionally, as I mentioned, the employer, your business, can make tax deferred business expense contributions of up to 20% of the profit or 25% of the compensation if you're S Corp or C Corp of the W 2 income for the year. Now, if you're under age 50, the max for all of this is 70,000. If you're there is a super catch up if you're between ages 60 and 63. If you're over age 50, it's 77,500 because your elective deferral, you actually have that $7,500 catch up contribution. And then for 2026, these numbers are going up. So 72,000 for 2026 is the max, and 80,000 for if you're over 50. So it's actually going up quite a bit, which is pretty cool. All right, so this is what we're here to actually dig into today. I want to talk about the deadlines to establish the plan and make contributions to the plan, and they vary based on the type of business you have. So, first of all, this is showing the deadlines to establish a solo 401k and still make prior year contributions. Okay, like right now we're in 2025. So what I'm mostly addressing here is after 2025 ends, when can I establish the 401k and still make a 2025 contribution? And I'll explain this, okay? So partnerships or corporations must establish the solo 401k plan by the tax filing deadline, including the extension. So you can see right there for S Corp, C Corp, the filing deadline is March 15th or April 15th, and then the extended deadline is September 15th or October 15th. So you'd be able to establish the plan all the way into next year by those dates if you extend, or if you extend up to those dates, and still make a prior year employer profit sharing contribution only. I'll talk about that in a moment. And then as a sole proprietorship, you must create the plan by April 15th and make those contributions before you file, if you're going to make them as prior year contributions. So April 14th comes around, you set up the plan. By the way, it's not a 1 day process. So don't come to us on April 14th and say, I want to set up a solo 401k and make contributions. It's not going to work if you're a sole proprietorship. It takes at least a week to set up, okay? And so plan ahead. But by April 15th, no extension, and you can still make prior year contributions, okay? Now I'll talk about the contributions on the next slide. Hopefully that makes sense. Here's how the contributions work. All business types can make contributions by the tax filing deadline for the profit sharing employer only, including extension. All businesses. Okay. Again, you have to marry this up with the type of business you have and when you have to set up the plan. Okay. Not all of them can go till the extension, right? As I just mentioned, sole proprietorship has got to be um, set up by April 15th, no extension. But you can still make the profit sharing contribution all the way up to the tax filing deadline, including the extension, which is October 15th. Okay, so hopefully that makes sense. All right, now this is where it gets a little bit nuanced. The employee or elective deferral contribution. For this one, as a partnership, you have until the tax filing deadline, including extension. As a corporation, you have the end of the taxable year because they must be processed through payroll. Okay. So this is that nuance where you're not going to want to go into 2025 if you're filing as C Corp or S Corp and you want to make those employee contributions because they must be done on payroll. Even though you can create the plan or establish the plan after the year is over, right? Again, all the way up to the business tax filing deadline, including the extension, right? So that's September 15th or October 15th. But if you do that after the year ends, you're not going to be able to take advantage of the 23,500, possibly even the 7,500 catch up if you're over 50 employee contribution because you're already past the point of processing payroll for 2025. And they have those types of contributions have to show up on the W-2, have to be done through payroll and be reflected on the pay stubs. So if you're S corp or C corp, you've got to act now basically because we're at December 11th and we're getting towards the time where it's going to be too late to set up the plan and process payroll and make the contributions before the year is over. If you're a sole proprietorship, you have to make employee contributions, you have until the tax filing deadline, no extension, April 15th. Okay. Now, one other thing I want to talk about, and this is the mega backdoor Roth. Mega backdoor Roth is, in my opinion, one of the more powerful ways to contribute to a solo 401k. And let me back up just a little bit, not in the slides, but in my conversation. An IRA is either traditional pre-tax or it's Roth. They're not, it's not both. You can have both, but they're two separate plans. Okay. You can self-direct a traditional IRA. You can self-direct a Roth IRA. Okay. Now with a solo 401k, you actually, the plan actually, our plans, this is not the case with like a Vanguard or Fidelity type of plan, but our plans, truly self-directed plans with checkbook control, have both Roth and traditional built into the same plan. So as I mentioned, when you make those contributions, they can either be pre-tax or Roth as the employee contributions. You can actually make profit sharing contributions as well as Roth. They just have to be converted to Roth after the contribution is made. But what I want to talk about is the mega backdoor Roth. Many of you may be familiar with this. Maybe this is the first time you're hearing it. And this really comes in handy when the dollar amounts of your W-2 income or your self-employment income, if you're not S Corp, C Corp running payroll, don't add up to enough to where 23.5 plus 20% or 25% gets you to that max of 70. Because with the mega backdoor Roth, you can actually make what's called after-tax employee contributions. Okay. Now, this is an employee contribution. So if you're S Corp or C Corp, these must be processed through payroll because they're on the employee deferral side. But you can contribute. Let me just break out some simple math. I should have created a slide for this. Apologies that I didn't. But let's say for a second you have $100,000 of net earnings for your self-employment. You're filing as a sole proprietor. Clearly, 20% plus 23.5 of 100,000 doesn't get you to the max of 70, right? That's 20,000, 20% of 100 plus 23.5, 43,500. That's a far cry from 70. All of that, again, can be Roth or traditional or a combination of the two. It's completely up to you. However, you can actually make all the way up to the 70 because you have the income. You have $100,000 of income. If you can afford to pay the taxes on the money, you can take all the way up to 70 and make an after tax employee contribution. This is a non deductible after tax contribution. Okay. It's a third bucket. You have the pre tax bucket, you have the Roth bucket, and then you have a third bucket, which is after tax employee contributions. So you'll make the contribution. Again, it's not tax deductible. It'll stay on your income for the year when you file taxes, and it goes into that bucket. Then immediately what you do is you convert it to Roth. Okay, so this isn't a percentage. This isn't profit sharing. This is just the same as your elective deferral, except it's going into a different bucket. So you can get all the way up to the max of 70 without having produced enough income for the profit sharing percentage and the elective deferral to get you there. This is especially helpful for those of you that have another W 2 job where you might be maxing out the elective deferral, right? So if I have a W 2 job at Walmart and I'm maxing out the 23,500 elective deferral, but I also have my real estate license and I make $100,000 of commission income even after, expenses and such. It's $100,000 net income. I can't contribute more on the elective deferral side as far as the 23.5 goes, but I can take 70,000 out of that 100 and put it into that after-tax employee contribution bucket and then immediately convert it to Roth. So not only did I put 23.5 in at my W2 401k, Roth, traditional, whatever, depends on what they offer, what you want to do, but now I put in another 70 of Roth in my solo 401k. If you did that, or even some of it, by the way, no one says you have to do the whole thing. If you did that over the course of 5 years, 6 years, something like that, and you get a modest return, 8, 10%, you are definitely going to have more than $1 million in your solo 401k in about 5, 6 years, give or take, right? Depending on the numbers and the returns and such. So this is one of the more powerful tools. The reason I bring it up on this slide is because if you're S Corp or C Corp, those after tax contributions I just talked about have to be done through payroll. So don't come to me or some other provider on January 5th and say, I want to make some mega backdoor Roth contributions to my 401k, but I haven't set up the plan yet. And even if you have set up the plan, you're too late to run payroll for 2025. You can do it for 2026, but not for 2025. So that's why I have that here in this slide, is because it really does apply to those S Corp, C Corp situations. If you're, again, if you're sole proprietor, then you have until the April 15th deadline to make those types of contributions. Okay. So hopefully that all computes with everybody. I know I just said a lot, but you can you'll get the recording of this. Feel free to rewind, pause. I'm definitely going to take some questions, but I do have a couple other things to cover real quick. You and your immediate family are disqualified parties to the plan, meaning they can't transact with the plan. You, your spouse, your children, their spouses, your parents, and your grandparents. The lineal descents save you and your wife. Well, the Bible says you and your spouse become one flesh, and the IRS treats you exactly the same when it comes to disqualified parties to your IRA or 401k. All right. So, they can't provide services, they can't be compensated by the plan, and none of those people can benefit from the investments the plan owns. For example, if the 401k or IRA owns a rental property, none of those people I mentioned can go spend the night there or stay there. Even if you pay market rent, you can't do that. Okay. Now, the other thing to keep in mind is what is a disallowed investment? Well, it's real simple. The IRS says you cannot invest in collectibles with your 401k, like baseball card stamps, wine collections, cars, antiques, that sort of thing, or um, collectibles and life insurance in an IRA. Okay. Those are the only restrictions, other than, like I said, the disqualified parties. Okay. Um, and then this is just a screenshot of the IRA versus the IRA LLC versus the solo 401k. I didn't talk about the self-directed IRA a whole lot, but the one that we set up is in the middle. The IRA LLC or IRA trust essentially is what gives you that checkbook control. The self-directed IRA on the far left there is the one that it's a self-directed IRA, but you don't have checkbook control, so you have to go through the custodian for all transactions on those. We don't set those up here at Sense Financial. We just don't feel like it's an efficient way to self-direct because of the red tape and the transaction fees that are involved when you have to go through the custodian for everything. So what we provide is the two columns on the right, the IRA LLC and the solo 401k. And one thing that I should mention is that the 401k has a participant loan option. You can borrow up to 50,000 or 50%, whichever is less. In fact, Avery, who I showed towards the beginning, sorry, I'm going to make everybody dizzy for a second. He actually, one of the first things he did, and I wrote it there, I forgot to talk about it, is that he used the participant loan to fund another hard money loan for his business. He borrowed 50,000 from his plan, did another hard money loan personally, so he benefits from the income. He used the proceeds to also pay off the loan to the 401k. And then a year or so later, he can do that again. I'm not sure if he has or not. I'll have to ask him, but that's what he did initially. The other thing is with the solo 401k, it's not in here, but you can fund it through doing a rollover of an existing retirement account and also make contributions. So any type of retirement account can actually roll into a 401k, and that is except for a Roth IRA. All right. And then usually, if you have a current employer plan, it's going to be tied up there until you leave that plan or that employer, with some exceptions. If you're over 59 and a half, or if you rolled over existing money from another employer that you left to that new plan, you can always roll that money out of there. And then the other thing is some plan adoption agreements will actually allow you to do what's called a in-service rollover, where you stay employed there, but they actually let you roll out some of the funds. And some adoption agreements with 401ks at W-2 jobs will actually allow you to do that before you're 59 and a half. So just ask the question if you'd like, and you can find out. All right. Let's see. That is pretty much it. Let's take some questions now. So I know I had one, and feel free to ask these. I'm gonna actually get into my. I'm streaming this live on Facebook. I want to see if anybody listening there has some questions as well. I'd love to ask those, or answer those. So I'll keep that up here. If anybody wants to ask some in there, then they can. All right. So let's see. Sid is asking how to convert a traditional 401k IRA to an after-tax account or Roth account with a least tax. Okay, so Sid, assuming you're still on, is it a 401k or is it an IRA? That's an important distinction because, as I just mentioned, at least with the solo 401k, you can't roll the Roth IRA funds into a solo 401k. They're already Roth funds, so there's no reason to turn them into anything else, right? They're already tax free anyway. It's a 401k. All right, thank you. So, um, traditional 401k funds, how would I roll them into it after tax? Well, They would never roll into after tax because they're already traditional funds. However, what you could do is you can convert. So there's a few different ways to get money into the Roth bucket. This is applicable to IRA or the solo 401k. It's just a lot easier in a solo 401k because it's inside one plan, as I mentioned, right? With the IRA, it's two separate IRAs. One's traditional, one's Roth. But let's talk about the 401k. So Sid, assuming you qualify for solo 401k, maybe you already have a solo 401k, I'm not sure. But either way, we could set up a solo 401k for you if you qualify for it, or if you already have it. You can. So here's the three ways, um, maybe four. Let me go through them to get money in the Roth bucket. One, you can make a Roth contribution. That's pretty straightforward. Two, you can convert existing cash, traditional cash in the plan to Roth. Okay, that's a taxable event. Three, you can convert an asset from cash, excuse me, from traditional to Roth. Okay. The other, and there really is a fourth way, and that's with the mega backdoor Roth that we talked about, which is another type of contribution. So it really falls into the first way, but it's a different way. So, or with some nuance. So the least tax outflow. Here's my opinion. Um, Again, I'm not a financial advisor. Talk to your tax advisor. But when you convert an asset, and by the way, I did a whole webinar on this a couple weeks ago. You can find it at SenseFinancial.com on the resources tab and webinars. It was like 3 weeks ago, and I went all into this with some examples. But basically, when you convert an asset from traditional to Roth, you must provide a valuation for that. And you can't do this on your own. It has to be a third party, basically an appraisal. When you get this appraisal, depending on the type of asset it is, there's going to be some factors involved that allow the value to come in at what's considered a discounted amount. Okay. So, one of the examples I'll run through that I went through in a few weeks ago in that webinar I mentioned was where a client of ours put 300,000 of his solo 401k funds into a syndication investment. It was a strip mall. He was one of many. It was like a $2 million something like that deal altogether, and he was only 300 of it. Well, he converted that to Roth. When he did the valuation, it came in at $200,000. So he got 33% off. What that means is that instead of paying $300,000, excuse me, instead of adding $300,000 to his earned income, his taxable income for the year, he added $200,000. However, it's it's worth 300. That's his principal investment. Not to mention now that 401k's entire that asset is all Roth. So all the future returns, when they sell, the appreciation, the proceeds from the sale will be Roth as well. The monthly payments or quarterly dividends or whatever they are that comes in from that are all Roth. Okay, so that's I think the best way to do it. Make a traditional contribution or take existing traditional funds, invest in an alternative asset like a mortgage note or a syndication investment, like I mentioned. Oil and gas works. There's all kinds of things that you can do this with, and then get that valuation and then do the Roth conversion at a discounted amount. So that's the least tax outflow. Okay. I can't predict what the value is going to come in at, but it's probably going to come in at a discounted rate. So yeah, no problem, Sid. Appreciate the question. I'll hang out for a few more minutes here and see if anybody else has any questions. Otherwise, if anybody would like to jump on my calendar, you can go to SenseFinancial.com/consultation and you can grab a spot. And I'm happy to jump on a call with you and talk through your situation. When you go there, actually, you'll see an option for a Zoom call or an option for a just a phone call. It's up to you. All right, we'll give it another minute or so, and then I'll wrap it up if nobody else has any questions. Okay, well, if you want to call our office, again, like I said, you can get on my calendar directly or call our office and do it at 949-272-8785, 949-272-8785, or email us at contact@SenseFinancial.com. I'm also at Brett, Brett, at SenseFinancial.com. And without further ado, I'll go ahead and log off. Merry Christmas, Happy New Year to everybody. Thank you very much.